our next presentation, it is going to be ticker AHT, Ashford Hospitality Trust. And we have, there he is, Rob Hayes.
Hey, Brent.
Hey, how's it going? You are president and CEO of Ashford. That is correct, right?
Absolutely. And I appreciate you putting the crown upside down. It was
I thought you were going to say, I thought you were going to say putting the crown away to introduce you. But
you can keep it on if you want. It's
okay.
fine.
Thank you. Look at that. Rob's a cool guy. We can tell Rob's a cool guy. Awesome, Rob. I'll let you take it away. Tell us a little bit about Ashford, ticker AHT.
Sure. Absolutely. Let me flip through a few slides here. So this slide actually gives a good sense for who we are. Ashford Hospitality Trust is a real estate investment trust that is based in Dallas, Texas, and we own approximately 100 hotels all across the United States, mostly Hilton, Marriott, Hyatt branded properties, some independent hotels. And this kind of gives you a sense for the types of hotels we have. And we obviously very high quality, very well diversified, which in this COVID environment, we think is very important to have a diversified earnings stream. And some of these assets that you can see here have been performing really well here of late. I mean, you can see the Beverly Hills Marriott there, our Savannah down in, our Hyatt down in Savannah, the La Posada in Santa Fe, Lakeway and Resort. And we do have some of these more resort leisure focused assets that have been doing quite well. But we've got a good mix of both leisure and business travel, less focused on group. And I'll get into some of those numbers here in a little bit. But this should give you a good sense for what we do on a day in, day out basis. What I thought I was going to chat a little about today are just a couple of things. I mean, one, given that the travel industry and the hotel industry has been hit obviously very hard over the past year and a half with COVID, we've as a company had to focus significantly on improving and repairing our balance sheet and building up liquidity. I'll talk about some of the steps and things that we've done on that front over the past year to 15 months. And then talk a little bit about our portfolio and how, as we are looking towards reopening, there are obviously going to be some hiccups along the way as we're seeing with this Delta variant, but the broader recovery has begun, and we think we're very well positioned from a portfolio standpoint, from an asset standpoint, to participate in that. So we'll go through a little bit of what we're doing on that front. This is the team. You also got to see Derek, the CFO of Braemar. He's also the CFO of Ashford Hospitality Trust. Jeremy Welter is our Chief Operating Officer and Head of Asset Management. And then myself, we've been together, the three of us, for 16 years here at Ashford. And so we've been through multiple up cycles. We went through the great financial crisis together. And also we've been through the past 2 years, the past 18 months together of COVID. And so it is a management team that's very close in terms of both friends and an experience of dealing with the hotel industry. So this is just who we are. So a couple of points to talk about the balance sheet. I want to talk a little bit about our monthly cash burn and how we're doing from a cash perspective. I want to talk about our debt maturity schedule. And I think that's really important because we definitely went into this, the COVID situation with too much leverage. But what your leverage is like and the qualities of your leverage can dramatically impact the seriousness of it. And so we were going to talk a little bit about what does our debt look like and how does it give us runway to continue to operate well. And then we're talking a little bit about the headway we've made over the last 12 months in deleveraging and trying to improve the balance sheet. So here's from a cash perspective. You can see that in the second quarter last year, the whole industry was in a very bad place. We were in lockdowns across the industry. Occupancies were at all-time lows. I mean, our occupancy at time was anywhere between 5 and 10%, where normally it could be 70 to 80%. And as a result, if you looked at our negative cash flow every month, it got nearly $40 million. In this case, it was about $37 million on average per month for the second quarter of last year. Well, you can look at the second quarter this year, and obviously we recovered quite a bit. When you look at the positive cash flow that we were coming off of our assets, the EBITDA coming off our assets, against some of the corporate G&A and interest expense, we were basically break even in the second quarter. And this has even improved a little bit going into July. We put out a report a couple days ago looking at our EBITDA at our hotels and reported that we were at, I think, $26 million of positive hotel EBITDA in July. So that obviously would be a cash flow positive month, which is great. We need to get back to regular cash flow positive levels. Now, there are some concerns about what does this look like over the next few months, because you do have the Delta variant, and it seems like that July number is probably going to be probably the highest number that we're going to have for the next few months, as August numbers are a little bit softer as we're getting back to school and this Delta variant. And then we've obviously got going into September and October, which is traditionally more of a business travel type time period. Well, that's going to be probably a little bit softer than, obviously than it was in 2019. And so we don't know exactly what those numbers are going to look like, but they're probably going to be a little bit softer than they were in July. But hopefully we're still at a place of being cash flow positive. So overall, though, from a cash flow perspective, we're in a much better place. We also announced in that release that as of the end of the second quarter, we had $530 million of working capital. So we've built up a pretty good cash balance, which we think is really important as we look at potential cash needs over the next few months, which I'll also go into here in a little bit. So let's talk a little bit about our leverage. So we had almost $4 billion of leverage, just debt, going into the financial crisis. It was about 3.7 plus preferreds. And as you look at the maturity schedule of it, if you've got, call it, $1 billion of debt and it's due in 5 years, that's very different than if it's due in 2 days. So when we look at our maturity schedule, it's very important to see how far out are these maturities. And if you look at over the next this year and next year, we really only have two significant maturities, both on individual assets. One's on the Marriott Crystal Gateway, which is right next to HQ2 for Amazon in Washington, D.C., right by Reagan Airport. That's coming due in November. And the Hilton Boston Back Bay, which is due next year. Both of those are single assets. They're obviously very high quality assets, and we're in the midst of doing refinancings right now on those. And so we hopefully will have things to announce on those here soon. So we think there's very little refinancing risk in terms of the next couple of years, and then it builds up over time. And we're obviously very focused on looking at positioning these assets to be able to refinance them in the next 4 or 5 years, which is when the vast majority of these maturities are coming due. And then in terms of the progress we've made from a deleveraging standpoint, you can see that all in, if you look at our perpetual preferred plus our net debt, we are about $4.3 billion in March of 2020. And as we sit here today, it's less than 3.5. So we've delevered by over $800 million. And that's a combination of handing back some uneconomic assets to lenders, of raising some cash along the way, of converting preferred securities into common. And so it's been mostly those three things. And you can see over time, though, there'll be other steps that we will need to take to get to a kind of a better leverage level. Historically speaking, we had been targeting 60 to 65% leverage as a percentage of cost. And I think we probably need to put that in a range long term of somewhere between 40 to 50 is probably a level that's, we think, more sustainable and healthier. And that's going to take a little bit of time. And so we will look over time to do asset sales, pay down some debt. If we have to hand back additional assets, we will. So it's going to be a process over time. But we've made a lot of good progress on that and put the balance sheet in much better shape than it was. So that's kind of the repair work that's had to be, we've had to do. What about going forward? And I think we're really excited about the portfolio we have as we're looking at the reopening and looking at the recovery. And we're going to see, as you can see, looking at this recovery the next few years. Let's go through a few aspects of our of this portfolio. So as we look at this recovery, we do think it's probably a 2023, maybe 2024 type recovery. That's what a lot of the industry pundits are saying. As we look at our own numbers and trajectories, I think 2023 is probably going to be the year when we're getting back to comparable EBITDA levels. But again, it's just a guess. It's just from looking at least what we're seeing from a current trajectory. But 2023, 2024 recovery is something where we've got obviously a good amount of upside in EBITDA growth over the next few years, which is very exciting. This is some of one of the big industry pundits in our sector is a group called Smith Travel. They're part of CoStar. This is their industry forecast. You can see RevPar, which is our revenue number, assuming revenue growth is 47% this year and 20% next year. There's a lot of growth and a lot of EBITDA growth that we hopefully will have over the next few years as we're getting closer to 2019 numbers. The other thing to note, which is a good thing, is that going through this crisis has tamped down supply growth a little bit, which is obviously a good thing. Less hotels coming into the market means better business for those who have existing assets. And so it looks like across most of the sectors, you're looking at somewhere between 1% and 2% supply growth, which you get nervous at is when supply growth gets to levels of 2% or 3% or 4% or higher. So having a 1%, 1.5% supply growth is great for our industry and our sector. And this shows a little bit of the trajectory, the RevPar recovery that we've had. If you look that we bottomed out in kind of April of last year, where we were down almost 95% relative to 2019. So it was just complete decimation across our industry and our company. And as we sit here today, or at the end of July, we announced that that RevPar numbers were basically about 20 to 23% lower than they were in 2019. So dramatic recovery. I do think you're going to see over the next several months that number probably drops again a little bit. I mean, as you can see, this is not just a straight line. It ebbs and flows as a wave on the way up. And I think this Delta variant is going to be a little bit of a lower amount, and then it'll continue to go up over time. So it's just not a straight recovery. The recovery is going to be it's going to ebb and flow. And so the next couple months will probably be a little bit lower, and then we'll continue to move forward. But clearly the trend and the reopening trend is there, which is good. As I mentioned earlier, this is just some supply growth metrics. Most of our assets are called upper upscale assets, meaning they're more full service Hiltons and Marriotts and those types of assets. And you can see the supply growth forecasted for that initial group, that type of asset, is pretty low over the next 5 years. It's all between kind of 1 and 1.5%, which again, those are levels that I think are very attractive and give us some good tailwinds going into this recovery. This is a good little snapshot on the overall portfolio. Again, we've got 100 hotels, almost a little over 22,000 rooms in 28 states. Again, very well diversified. And these down below, you can kind of see, again, what we tend to focus on. So we are almost 90% focused on Hilton and Marriott branded families. We also have Hyatt in there as well, which is very important to us. But we're looking at kind of best-in-class brands. We think that's what drives the most business for travelers. It's also important in our business, since we as a REIT, as a hotel REIT, can't physically operate our properties. We have to hire third parties to do that. So we try to hire the best out there. And so most of our assets are managed by our affiliate in Remington. That is a subsidiary of Ashford Inc. They are, in my opinion, the best in the business in terms of managing costs and driving revenue. But then we've got some great brand partners as well with Marriott and Hilton and Hyatt that also have a majority of the rest of our assets. So great property managers. Again, most of our assets were about 75-25 in terms of full service versus select service. So again, 25% is kind of courtyards and residence inns and Hilton Garden Inns and the like, and the rest are full service Hiltons, Marriotts, Westins, Hyatts, Renaissances, etc. And you can see that as well in upper upscale, again, as that kind of full service type asset. We also do have some luxury assets. You saw Derek at the previous presentation. Braemar focuses extremely, exclusively on luxury assets. We do have some of those as well. For example, we own the Ritz-Carlton in Atlanta, would be an example of a luxury asset that we own. Again, this just shows a quick little blurb about last year of looking at, from an operating standpoint, why we work with Remington. There's just some looking at labor cost, managing gross operating profit declines. Remington has a reputation as being one of the best in the business in terms of managing costs, and it's a big competitive advantage for us as we're managing assets through a very volatile and uncertain time. You want to have groups that are very nimble in how they manage costs. And Remington's really good at it. As we look forward in terms of into 2021 and beyond, of where do you want to be focused, we really like being in the luxury and upper upscale and upscale segments, because that's where RevPar growth is going to grow the most. They were the groups that were hit the worst during COVID. The economy and mid-scale and lower quality hotels were hit much less. They're most of them are pretty much already back to 2019 levels. If you're looking for growth and looking for upside and looking for places to participate in the recovery, you want to be on the higher end of properties. And so that's why we're excited about having a kind of luxury, upscale, independent type focused, because that is where the RevPar growth is going to be, revenue growth is going to be over the next several years. All right. So, and then when you look at the mix of business, this is going to be a big issue, is that given the uncertainty around the recovery of business travel and really the uncertainty of group business. So group business is going to be probably the last to come back. We historically have not been a business or a group focused company. So as you're looking on the left side, we've got about 25% of our business historically has been what we call transient. That's both leisure and business travel. And then about 24%, this is in 2019. Here more recently, it's probably closer to 20 to 19%, but is group business. So call it a fifth of our portfolio is traditionally group business. That's a pretty low compared to most of our peers. So we're very focused on the transient business, which is probably the best way to play this recovery over the next few years. And then when you look at what percentage of that transient business is leisure versus business, the vast majority of that is leisure. So we are a leisure transient focused company, next business transient focused, and lastly group. So we like the mix of business that we have, and we think it's going to participate very well in a recovery, given the way that we think group business may lag a little bit. Again, looking at some of the focuses on from a market standpoint, we are focused predominantly on top 25 markets, but well diversified. You know, if you were a company that just focused in the top 5 markets, say DC, New York, San Fran, LA, Miami, Chicago, those sorts of markets, this obviously your recovery may be much longer in terms of coming back. We have a much more broad diversified portfolio. There's a lot of great markets out there that a lot of investors, institutional firms didn't look too kindly on or look down on, that have been proven wrong this time around. It's great to have assets in Tampa and in Santa Fe and in Austin and in Nashville and Savannah, and these markets that we've loved for many years, and they really got to prove their value out here over the past 18 months. So we think diversification, particularly given that in a COVID environment, you may have regional hotspots and different markets and different government agencies and municipalities taking different measures. It's good to have a broadly diversified portfolio, and that's what we have. We also, though, think there's some very good underlying demographic changes that we want to participate in. So this is a study that has been done by North American Moving Services, where they're looking at where are people moving over the past 4 or 5 years. And so those states in green are the states that people are moving to, and the states in red are the states that people are moving from. And you can see that 12 of our top 17 markets across our portfolio are in these states where people are moving to. And so we do think it's great to have exposure to Texas and Arizona and Florida and Georgia and the Carolinas and Tennessee and Virginia, where people are moving to. And so that's we think there's some broader demographic tailwinds to our portfolio because of that. So in conclusion, we've done a bunch of repair to our balance sheet over the past 18 months. There's still more to go over time through a variety of ways, but we've made substantive progress on that. So there's we feel very good about where we are from a liquidity standpoint. And then as we look to recovery, we're excited about our portfolio. We think it's got the right types of assets, the right types of business, and the right types of markets. So we're well positioned to capitalize on this recovery. And so with that, that will be that's all I've got for now.
Awesome, Rob. Thanks a lot. Would you mind taking a couple really quick questions?
Yeah, that's fine.
Okay, awesome. So, you mentioned a timeline. You said 2023, 2024. You kind of said maybe more likely 2023 for your team. Out there in the real world, I mean, what is the catalyst that your management team is focused on?
Well, I think it's a couple things. I mean, one, what we're really trying to understand is, leisure business has come back strong, and that's been great. And it's actually come back at levels that were stronger than they were in 2019. What we don't know is what is the future of, for us in our business, is the future of business travel. And it is unfortunate that this Delta variant has pushed back, as you well know, and a lot of people know, that they've pushed back a lot of businesses to the dates that they were coming back, right? Initially, as everyone's coming back on Labor Day, coming back to their businesses in New York and San Fran and DC and whatever. And that seems to keep getting pushed out a little bit, right? And so you've seen announcements from Amazon and Apple and Facebook that it went to October and then November, and some even now in December and January. So that's for us the biggest focus, is how can we, one, get business travelers back on the road, and two, what does then the future of leisure travel be? Because it's going to be a little bit before people can probably travel the way they did in 2019 and previously. But if people are staying at home and you've got people that are now working remotely from different places, that may be real opportunities to grow leisure business in ways that haven't been done before. And people may be, maybe more willing to either work from remote locations, work from hotels, work from, places while they're on vacation. And that can give us some opportunity to hopefully fill in some of those gaps that we're going to be missing for a little bit on the business travel side.
And we do have some loyal AHT investors in our YouTube chat. They're asking some good questions here. And, loyalty is great, but obviously they have been with you a little while the stock was much higher than it is right now. A few of them are asking, what are some actions that you are and your management team planning to take to try to support the stock price a little bit? One specific question. I don't think you guys have done this before, and I don't know how traditional it is in the space, but, something like a buyback, any idea like that on your guys' radar?
Yeah, that's a good question. So the first thing that you can look at is that I actually just bought a bunch of stock this week. So I'm trying to put a little bit of my money where my mouth is. So
good.
I bought stock this week. I filed a Form 4 yesterday, and people.
Great.
So step one. The problem is, from a buyback standpoint, is that I have restrictions against that. We went through obviously a very difficult time, and we took basically a rescue financing from a big private equity firm, and more or less until they are out of, until I pay them off, which I still probably have a year and a half before I can pay that off, I'm restricted from doing buybacks. I'm restricted from paying common dividends. I'm restricted.
Makes sense.
So until we get a little bit more runway, unfortunately, I've got my hands tied on that front.
I hear you. And, I'm sure investors out there know when a stock is at some kind of low, it's a really good thing to see management putting their money where their mouth is. Just like you said, how many shares did you buy? I didn't get a chance to look at the Form 4.
I bought about $100,000 worth this week. So
okay, awesome.
A good little first step.
Excellent.
Well, the other thing to recognize, and the reason we put out this release earlier this week to talk about earnings, our performance, was that we've obviously built up and have needed to build up a good amount of cash balance and liquidity because of the uncertainty around this recovery. We just don't know what's going to happen, as this Delta variant has shown us. And gosh, what happens if Lambda's worse, and all of these different variants? Because there is a lot of, there's a lot of tension and uncertainty around what does it mean in our economy, in our government, but also in our industry specifically, as we transition from a pandemic mentality to endemic. And realizing that COVID is going away, it's here, and we need to be able to adjust. Well, what that means for our business could mean a lot of volatility, but as a result, we've built up, well over $500, almost $600 million of liquidity and cash on our balance sheet, which, if you look at that value alone, it's like $18 to $20 of stock price. So we actually have more cash on our balance sheet today than our equity market cap. So there's definitely a little bit of a disjointedness between the way that the market's currently valuing our stock. I mean, you could think about it this way: buy the cash that we have today for less than what's on the balance sheet, and get our hotels for free.
It's a great point
going on right now.
Absolutely. And for better or for worse, unfortunately, it is a theme. Even just today, talking with some of the execs today in the real estate space, it is a theme that our management teams are being conservative and being prudent. I think it's a great idea to be prudent in this time where there is a lot of uncertainty. I wish it wasn't that case, but that's the reality of it, right?
Yeah, no, it is. And it is unfortunate, right? I wish that it could have been, all right, we bottomed out in April of last year, and it's just a straight line to previous levels, and everything is fine. But given we're dealing in an uncertain environment, we've got to be thoughtful around how to ensure that our companies not just survive, but thrive on the backside of this.
Mhm.
And that requires us to be probably more conservative in our balance sheets than
Absolutely.
we would in a normal recession. Right? I mean,
Right.
we have to remember that Braemar that Derek talked about was not in this situation, but I was in the situation at Ashford Trust where we basically had 3 different documents laying in front of us, right? One of them was, I'm going to fire sale a bunch of assets at terrible prices in order to build up liquidity to try to save the company. The second one was to sign a rescue financing deal in order to save the company. And the third was file bankruptcy. And that last one was a real thing that we got very close to doing. And if we don't build up our balance sheet and liquidity profile to a place that is where it needs to be, in another wave or another version of that, that comes back on the table. And that's what I'm trying to avoid at all costs. I don't want us all to be wiped out because we got pretty close before.
Right. Well, like I said, Rob, a lot of loyal investors here in our chat, and that's what this is about, is connecting you executives with your investors out there so you can speak directly. And that's what I wanted to do here. So I really appreciate you taking those questions.
Absolutely.
I think the viewers got some good answers there. Thanks for joining us.
You got it. I appreciate it.